Well, good afternoon, Michiganders. It is Tuesday, January 16, 2024, and of course, this is Tuesday with Tom, Michigan's only weekly podcast where we answer your questions about estate planning and estate settlement in Michigan, and we don't send you a bill. I'm your host, Tom Doyle, estate planning attorney, lifelong Michigan resident, and an ambassador for all things good in this great state of Michigan. Welcome to today's program. Just a brief note. Happy to report, I think I mentioned it perhaps in the last episode, we now have a new website for Tuesday with Tom, so check out the new website. Let us know what you think. One of the things that you can do at the new website, there's a little microphone on the website, so if you're listening to an episode and you've got some question or some thoughts on that episode, or perhaps what else you would like to have me cover in the future, just click on that microphone. You'll be able to send me a recorded message. Speaking of last week's episode, it was a 2024 law update. I talked about many of the legal changes that were coming about in this year. So if you've got questions about changes in 2024 law, perhaps it had to do with taxes or the probate code or anything else along those lines, then I invite you to listen to last week's episode. But kind of continuing along, if you will, the same theme, today's show is to be prepared for when Trump's tax cuts expire next year and taxes for most Americans will increase. But please remember, what I'm about to discuss is, as always, for educational purposes only. It is not intended to be legal advice. You need to work with your attorney and your tax advisor and financial advisor to determine what is appropriate for you and your estate. Be prepared for when Trump's tax cuts expire next year and taxes for most Americans will increase. If you look at during Donald Trump's time as president, he signed what had been passed as a Tax Cuts and Jobs Act, and that was in 2017. And as a result of that law, there were a number of things that happened to reduce your potential tax burden, including individual income tax bracket. There was a restructuring of individual income tax brackets. The highest rate prior to that was 39.6%. It dropped down to 37%. Also, the earnings that were subject to the tax rate were also changed. So a single person who now had earnings, they could have over $500,000, where before it was $427,000. That number is actually $609,350 in 2024 before you will be subject to that highest rate of income tax. Married people, prior to the 2017 Tax Act, the amount that you could have when the tax rate started kicking in, the highest rate, was $480,000. That number went up to $600,000, and because of an inflation factor, it is now $731,200 in 2024. So for those of you at the highest earnings rate, significant tax savings because the rate dropped from 39.6% to 37%, and the amount of income that you could have before it was subject to that highest rate also went up. Other tax brackets, a 35% stayed at 35%, 33% dropped to 32%, 28% dropped to 24%, 25% dropped to 22%, 15% dropped to 12%. So across the board, there was a general reduction in the tax rate, and then the folks in the 10% bracket stayed the same. So, significant income tax savings for individuals as a result of passing that statute. The problem is that those reductions in the income tax brackets and the amount of income that you can have before it's going to be subject to the highest tax bracket will expire at the end of 2025. So at the end of 2025, we're going to go back to the highest rate of being 39.6%. We're going to go back to lower amounts that you can have before it's going to be subject to that income. And across the board, the 33% will return, the 28% returns, the 25% returns, etc., etc. That is all assuming that Congress does not enact any new legislation in the meantime extending those cuts. Well, if you look at what Congress has been up to lately, they can't seem to agree upon anything other than continuing to kick the can down the road when it comes to putting together a budget for the country. I'm one of those people that is pessimistic about the possibility that Congress might do anything that would positively impact those changes. So now you need to start planning. You need to look and say, okay, if the tax rate's going to expire, go up, and more of my income is going to be subject to tax at the end, what can I do now? Now's the time. Meet with your tax advisor to see what you might be able to do, essentially to take advantage of the lower tax rates that are set to go up in 2025. Possibility, and again, these are things to talk to your tax advisor about. Maybe you'll consider a Roth conversion, Roth IRA conversion. Take a traditional IRA, convert it to a Roth. Now, when you do that, you're going to pay tax on the money, but by converting it at a lower tax rate, you might be saving yourself some tax in the long run. But if you're going to do it too, think about this. You've got 2 years, so you can spread the conversion over 2 years so you're not stuck with taking it all in 1 year. Another consideration, perhaps you're going to defer deductible expenses, and we're going to talk about what's going to happen with the standard deduction, but you might start looking at what expenses you've got. Maybe you can defer some of those expenses until the change in the tax law. Another possibility, maybe you can front load some of your withdrawals from your pre-tax account. So you got 2 years. You know you're going to be taking the money out of your pre-tax accounts, maybe a traditional IRA, 401k, whatever it happens to be. Taking the proceeds out now at a lower tax bracket might be a strategy that your tax advisor and your financial advisor would recommend you consider. Deductible expenses. The other change, another change that occurred as a result of that act was there was a change in the standard deduction amount. Standard deduction amount was raised from $6,500 to $12,000 for a single person. Standard deduction amount was raised from $13,000 to $24,000 for a married couple. What did that do? For many people, they no longer itemized deductions because we had the standard deduction that had been gone up to $12,000 for a single person. So if you didn't have itemized deductions that would account for more than $12,000, you were better off taking the increased deduction. Married people, if you didn't have deductions that exceeded $24,000, you were better off taking that standard deduction. Well, at the end of 2025, when these tax standard deductions increased, they are now going to go back to what they were in 2017 before they went up, which is essentially cutting the standard deduction in half. Well, if you look at what you've been doing with the standard deduction, if you've been taking it, but if it goes to half of what it is now, maybe you will have deductions that will exceed that amount. And so you need to reevaluate and look at with your tax advisor what impact it might have on you when the standard deduction is decreased by half at the end of 2025. So those are kind of on the income tax end of things, changes. Now, as I talked about in the last week episode 2, we also have to look at the federal estate tax exemption. So let me just review that one more time with you. The federal estate tax exemption is the amount that you can have in your state before the federal government is going to collect an estate tax at the time of your death. That exemption amount currently in 2024 is for a single person $13,610,000, meaning what? If you die this year and you are single and your estate, when you add it all up, does not exceed $13,610, you don't owe a federal estate tax. If you have an estate that is over that, it's going to be a graduated scale that tops out at 40%. Married people, 2024, you can have an estate worth $27,220. That's the federal estate tax exemption amount, essentially for the married people, twice as what the single amount is. And again, if you die this year and your spouse dies this year and your estate does not exceed that amount, you won't have a federal estate tax due. 2026, so this is when the 2017 law expires. That single $13,610,000 is now going to drop by half, over half, to $5 million. Married people, it's going to drop by over half to $10 million. Now, those numbers will be adjusted for an inflation factor. We're not really sure what it's going to be, but guesstimates are that $5 million might be more in the range of $6 million or so. That $10 million might be more in the range of $12 million. But if you're counting on a federal estate tax exemption of $27 million, and now you only have 12, or you're counting on a federal estate tax exemption of $13 million, and now you only have 6, you have some significant planning that you need to take a look at. And that planning is very much going to revolve around what are the options available to you, perhaps to start looking at shrinking the size of the estate. You might start using gifts more than you're using before, or if you hadn't been using gift strategies, to use gifts as a way to shrink the size of the estate. You might look at 529 plans as a way to shrink the size of the estate. And I've had previous episodes on the program where I talk about the advantage of using a 529 plan is that you can front load it with 5 years worth of gifts. So you can take what otherwise was, let's say, a $6 million exemption in 2026, front load that with 5. Well, if you look at a single person now who's got 13 million, you can front load a lot of 529 plans and look at potential federal estate tax savings. Now, the good news, we have this concept of portability with spouses. That's how we generally say spouses have that $27,220,000, because we can essentially add both spouses' federal estate tax exemption together. And we're still going to have portability for spouses in 2026. But now is the time to start looking at planning. Maybe you're going to look with your financial advisor and tax advisor and conclude that, hey, my estate, our estate, is such that we can't reduce it. We don't really have options available to us to reduce that estate below what it looks like the exemption amount's going to be in 2026. So today, another thing to start looking at today is a question of maybe now, and I've talked about this in previous episodes, maybe now's the time to visit an ILIT, an irrevocable life insurance trust. An irrevocable life insurance trust isn't a tax savings. It's a way to purchase life insurance, so where the proceeds of the life insurance will be used to pay any federal estate tax that you have. So you buy a life insurance policy, and when you die, those proceeds are used to pay off the federal estate tax that otherwise you weren't able to shrink your estate enough to do that. Well, an ILIT, it's an irrevocable life insurance trust. It buys the insurance policy. And so if you're going to look at possibly buying insurance to provide the liquidity, maybe you're a farmer who doesn't have the liquidity to pay a federal estate tax, or a small business owner who doesn't have the liquidity to pay a tax. You don't want to have to sell the farm in order to pay the tax. You don't want to have to sell the business in order to pay the tax. You might using life insurance inside of an ILIT to do that. But now is the time to start looking at that, because if you're looking at life insurance, as we all know, you might have some health issues that arise between now and the end of 2026 that might preclude you or make it prohibitively expensive to purchase the life insurance. So now's the time to start looking at those options going forward if you're going to look at life insurance as a way to provide liquidity. The federal gift tax exclusion, as I talked about in last week's program, that's how much can you give anyone in any 1 year before you have to worry about gift tax on it. In 2024, that amount is $18,000. It's expected that that's going to go up to $19,000 next year, but kind of a strategy that is oftentimes being used is, can you make gifts, keeping them below that $18,000 or $19,000 so that you can shrink the size of your estate that would now be subject to federal estate taxes. And the good news, and I talked about this in previous episodes, is let's say a single person today gave away $13,610,000. That's the amount of the federal estate tax exemption. And then they die. They would not have any exemption left because they used it all up by deferring paying gift taxes on that $13,610,000. The good news is, according to the IRS, if you take advantage of that federal estate tax exemption now, let's say you gave away $13,610, but now you die in 2026 when the exemption amount is only $5 million, because you took advantage of the $13,610,000, that is still going to be good for you. It's not like when taxes are going to be calculated, they'll be working from that $5 million number. So there can be advantages potentially in making what otherwise would be taxable gifts and using up some of that federal estate tax exemption between now and the end of 2026. Now, one thing that the statute, the Tax Cuts and Jobs Act did do, which is quote unquote permanent, if you think about anything that Congress is doing is permanent, is before that, the maximum corporate tax rate was topped out at 35%. That changed to a flat 21% tax rate. So for corporations, there was a big change, a tax savings, and the good news for corporations is that that continues on past 2025. So we're really talking about the impact that all of this is going to have on your individual taxes and your estate, not talking about your corporate tax rate. So again, you need to start thinking about it and looking at it and planning for it, because if you wait until the end of 2026, it might be too late if you needed to take advantage of, let's again say, doing a Roth IRA conversion over a couple years, or to front loading withdrawals from your pre-tax accounts over a couple years, which is why you need to start looking at that with your tax advisors now rather than later. Of course, even though Amanda and I are not tax advisors, so we can certainly look at how that impacts your estate, what estate options you have. Maybe you need that ILIT created for you. That's certainly something that we can do. maybe you need some adjustments to your estate plan, distributions, etc. Those are certainly things that we can work on with. So we would love to have the opportunity to help you, whether it's amending a plan that you already have, putting a plan in place that will protect your loved ones by having an appropriate estate planning in place, or perhaps you need assistance in settling your estate. All of those things are certainly things that we can help you out with. Simply go to doylelawpc.com, go to our website. There you're going to find information on how you can schedule a consultation with us. It might be a Zoom or telephone conference. It might be an in-person consultation at the East Lansing office. All of that information is available at doylelawpc.com. Also, just a simple reminder, if all you're looking for is a new document, maybe all you need is a new durable power of attorney, you can simply go to the legal store, which you're going to find at doylelawpc.com, click on the link there, and you will see information on how you can actually order individual documents from us that will be able to be prepared and sent to you for execution. Well, that's going to be it for today's show. As always, though, if you have a comment about the program or a topic that you'd like to have me discuss, perhaps questions that you'd like to have answered, send me an email, tom@tuesdaywithtom.com, or by using the new website, whether you're doing it on a computer or doing it on your smartphone, simply click on that microphone button and leave us a voicemail on a topic that you would like to have us discuss or comments about the program. Also encourage you to follow us on Facebook. That would be tuesdaywithtom.com. Follow the office at Doyle Law PC. And of course, we would request and encourage you to invite your friends and family to follow us as well. Remember, too, program is available on Apple Podcasts, Spotify, Google Podcasts, iHeartRadio, Spreaker. Recently have added additional distribution channels for the program, including Amazon Music. So wherever it is that you listen to your podcast, you can likely find Tuesday with Tom, and at those services, and including at the website, you can now set up your service to follow us so that you'll automatically be notified of upcoming episodes of the program. And as always, too, you can ask your smart speaker to play Tuesday with Tom. Well, thanks again for spending some of your time with us today. And as always, I hope that you have an awesome day and an awesome week. Stay warm and stay safe. Tuesday with Tom has been brought to you by the estate planning attorneys at Doyle Law PC. To learn how we can help you with your estate plan or with settling a loved one's estate, please call us today at 517-323-7366. That's 517-323-7366.